Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast app, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 45 in our series for 2020, and today's date is Friday, December the 11th. First, I'll be talking to Tommy Huppert, founder and CEO of medicinal cannabis company Cannatrek, which is developing export markets for Australian medicinal cannabis. And I'll be talking to IFM Investors economist Alex Joyner about the latest GDP figures and the state of the Australian economy moving forward. But now let's talk to Tommy Huppert. Tommy, Cannatrek now has a production facility in Shepparton, and you've identified several strains of medicinal cannabis, and you just secured an export license to the UK, and you've done it so quickly. How'd you do it?
Oh, I believe in miracles. You know, we're dealing with, this is not rocket science. I would say the bureaucracy is probably rocket science. It's been a hard journey, but, you know, fantastic team. It's all about the people, Leon. I've got a very loyal, passionate and brilliant team who are just love taking care of the plants. There's a lot of R&D, hard labor, hard work, tremendous effort by Team Cannatrek.
That's fantastic. Now, this medicinal cannabis is to treat what sort of illnesses?
Oh, we're finding that it's touching a tremendous array of medical indications, from sleep assistance to movement, mental health, palliative care. Even we're seeing treatment in difficult diseases, whether it's cancer treatments, so autism, women's health, men's health. It's endless. And I think the best way to describe it is, over 100 years ago, the cannabis plant was one of the main ingredients in pharmacopoeia. The classic story is, if you go to Ballarat, you'll look on the shelf, you'll see in the pharmacy, you know, a bottle of cannabis sativa oil. They were probably growing it out the back of the pharmacy and mixing it and providing tinctures, just like a compound pharmacy today.
It's pretty simple today. You go to a pharmacy, you hand over your script and identification, and you leave with your purchase. Is that right?
That is like any other medicine. We're seeing far more convenience being included, whether it's eScript, which rolled out a month ago, or telehealth, where you can visit your doctor via this forum as we're talking now, and all the way for the medication to be delivered securely to your door. And I think the last 9 months in Australia certainly triggered lots of innovation in the delivery of healthcare, which is here to stay forever.
Well, tell us about the R&D that goes into growing cannabis plants.
The most important aspect of a successful operation is the quality of your genetics. There's hundreds and thousands of different types of plants, just like, you know, you have all different types of tomatoes or apples. We're trying to find the plant which is really sturdy, that can survive through extreme weather events, which happen every few days in Australia, where it's too hot, too cold. So we're creating this stable environment in the greenhouse. You can see behind me, there's a lot of fans and screens and irrigation. So the key is to have those stable genetic lines that we can predict and always produce a sturdy plant. So it would be important to have it for each crop cycle? Yeah, so traditionally we grow from seed, and then we pick out the most robust plants, and then we clone those plants. It's a bit like, you know, your kids, they all look a little bit different. If you have twins there, they can look almost identical. So we're actually trying to create identical plants, because then they flower at the same time. We're trying to choose the plants which are more pest resistant. We have a lot of biological creatures in our greenhouse. We don't use pesticides at all. So we're really trying to replicate Mother Nature. And how many do you have working for you now? We have around 20 people in our site up in Queensland, which is a really neat size. So not too big, not too small. It enables us to test a lot of our systems. We're looking at different types of lighting, of LED, irrigation. You know, we're grabbing mass data so we can scale up in a Shepparton facility, which is very exciting as the industry is really getting up on its feet.
And how many do you have employed out at Shepparton?
Shepparton is still a greenfield site. We haven't started construction. We've been doing all the preparation that you do before you build your home, architecture, permits, etc., power connection. So that's all lined up really well.
So when do you expect the Shepparton site will be up and producing?
We hope to start the site works early next year. It will take a good 12 months, so early 2022. But meanwhile, we're in full perpetual production. So we're in a really nice sweet spot for Canatrek. We've had some tremendous successes on sales this year. We've already reached a record this month, and it's not over. We are taking care of over 3,000 patients. We have a referral service which we started last week called Canatrek Access, where we take inbound inquiries where patients are looking for the appropriate medicinal cannabis prescriber, and we're pointing those inquiries to the appropriate doctors. So it's very exciting development that we're be producing and releasing Australian-made medicinal cannabis.
And it's very timely too, occurring during the time of the pandemic.
Well, we've seen a big spike in a lot of the illnesses which may provide an insight for traditional use of medicinal cannabis. Mental health, unfortunately, anxiety, things which we've seen spike. Do they help? We are finding out there's most of the prescriptions are going for pain, chronic pain, the sore back, inflammation, and people are making an informed decision. Patients are doing their research and going to their doctor and saying, what about medicinal cannabis? And the doctors are now becoming more au fait and more comfortable with prescribing a non-registered medicine. And the results have been quite extraordinary from patients.
So how much products have you actually sold in Australia so far?
We've sold over 20,000 units over the last 2 years. So we see, over 100 scripts coming through our team every week, and they're increasing. So we're seeing this organic lift in people's understanding of medicinal cannabis, doctors' appreciation for applying for approvals for this new medicine. So it's moving quite quickly, and I would say even exponentially. It used to take 3 months to get an approval, now takes a day or two, or even sometimes on the same day.
So doctors are quite familiar with it, quite cognizant of the properties of medicinal cannabis now.
Yeah, well, we're hearing every day. If you do a Google, you'll find an article almost daily in the press. So there's certainly an awareness, and we're seeing far more. I would say there's less stigma, and there's more curiosity is the word I'm looking for trying a natural product.
And you've secured an export license to Austral Health in the UK.
Yeah, we've been very fortunate to create a pipeline of export. The products which is herbal cannabis, will leave shortly to the UK, where it will be used in a part of a observational trial, where herbal cannabis is similar to Australia, non-listed, but patients are willing, with doctors providing care.
That's quite exciting. And do you see an export market developing there?
Yeah, so the UK, twice the population as Australia or more. They're probably about a year behind where we are. So we see a tremendous opportunity. They are looking for imported products because they're not producing like we in Australia. So there is definitely an opportunity for Canatrek to succeed in new markets.
Well, that'd be quite exciting, and you'd have other countries too, wouldn't you?
Yes, we're also in dialogue with a number of other European countries: Germany, Poland, Czech Republic, Italy. We're seeing literally nation by nation look at medicinal cannabis as part of their medical array of options for patients.
Well, that's pretty exciting. So, what's the next stage for Canatrek after this?
Well, the next stage for Canatrek is to bring local production to Australian patients and really pivot from an importer predominantly to a local producer. and also provide the beginning of our scaled opportunity, where we are also not just a seed to patient business, but we want to be in profit too. So sometimes we coin seed to profit. It's been a challenge, I think, for most companies in the world, but we've got a real opportunity to take care of patients and provide an affordable option for them. So I think 2021 will be an exciting year for the industry in Canatrek.
Well, it'll be fascinating to watch, and let's keep in touch, Tommy. Thank you very much for your time.
It's been a pleasure today, and thanks very much, Leon. And
now let's talk to IFM Investors economist Alex Joyner. Well, Alex, the Australian economy has pulled out of recession with the latest GDP numbers, but that's technically pulled out of recession. It's the economy is 3.8% smaller than it was before, and we've still got restrictions on travel and immigration, so population's not going to rise, and as well as that, we've got need for ongoing fiscal and monetary support, as just by Philip Lowe. What's your view about this?
Yeah, so we did get the national accounts for the third quarter, Leon, and they did have some surprisingly good news, and that's what the headlines were reflecting. The Australian economy grew 3.3% in the third quarter. Now, that was better than expected, and certainly better than was expected at the time of the Victorian lockdowns. So when we entered stage 4 and they became very, very strict, there was some quite dire predictions about this third quarter, and it could be a negative. Now, as it turned out, Victoria, in terms of its state final demand that's measured in the national accounts, actually only went back 1% in the third quarter. And I think economists had been expecting a much, much bigger impact. Not to say that that's a good result, but it was relatively good compared to what we were thinking. New South Wales and Queensland, by contrast, expanded 6.8% in the quarter. So obviously, as restrictions lifted, the rest of the country has bounced out of COVID restrictions and seen that growth. Yes, we are technically out of recession. The headlines sort of trumpeted that quite far and wide. I guess that is technically true in that definition, but there are many other definitions of recession, and the one that I would probably focus on in this regard, and I think the one that policymakers are actually looking at, is just looking at the labour market and where we're sitting there. We have an unemployment rate that's 7%, much higher than we would like it. And we're in a situation where, that has yet to appreciably come down. And that will be the measure of how well we do coming out of this, is how well we can get that unemployment rate down. And as you say, that may become more difficult because, we are still in an economy that is around about 4% smaller than it was. And the next iteration of growth is going to be a little bit more difficult. We're going to get a little bit more of a tailwind in Q4 because of Victoria opening up again and becoming positive again. So that's good in Q4. But as we enter 2021, we should still get growth, but it is becoming more difficult to generate because some of the important sectors of growth, this is tourism, education, population growth, all these things that rely on people coming from overseas to Australia to spend money. We know that they won't have opened, at least in the first half of next year, optimistically, maybe the second half of next year. And that's where markets are really pricing in some pretty good news around vaccines, particularly the US stock market, which continues to push to record highs, is really pricing in some very good news on vaccines. Now, Australia's seemingly just sitting back and waiting. We're actually in the enviable position, I think, of having the virus under control. We can continue to open up our economy and then sit back and look at the UK and the US that are rushing to employ the vaccine because they have case numbers that are very, very high. So we'll have that luxury through our summer to just see a real world deployment of the vaccine. And hopefully we can learn from that when it comes our turn next year and do it successfully to open up our country.
There are a whole lot of other issues with other economies. For example, in the US, you've got advanced stages of coronavirus. Joe Biden is going to be the next president of the US, but there's a lot of political uncertainty because of the Senate outcome. We don't know how that's going to go and, whether they're going to have fiscal stimulus. And so there's problematic there. And of course, the UK economy is also going through its issues as well.
Well, that's right. It's interesting that Australia, with its 3.3% expansion in the third quarter, has underperformed the global average, or the global median, I should say. You know, we've seen economies, the UK bounced 15% in the third quarter, Europe 12.5%, the US 7.4%, because they opened up quickly and are now paying the price for that. Interestingly enough, you would expect Australia to outperform in the fourth quarter, and you know, the US to struggle with growth, the UK to struggle with growth, and the Eurozone to actually record a negative quarter in the fourth quarter. That's what most people are thinking. So they've got a bumpier path going into 2021, whereas Australia might have a little bit more of a consistent path. The other issue, as you say quite rightly, in the US is the uncertainty around not the election result. I think we've settled on that Joe Biden is going to be the president come January 20 next year. It is around the fiscal package that is desperately needed. When we talk about fiscal cliffs in Australia and we worry about those sort of things, you know, the government has been receptive to those concerns insofar as it has extended things like JobKeeper and JobSeeker. Now, they might be in a little bit of a different form, but they have been extended, and I would expect them to be extended again. What you have in the US is a much more adversarial political situation where, you know, the Republicans and Democrats are very much seeing the way forward on fiscal stimulus differently. And, you know, we were talking, you know, perhaps a month or two ago about fiscal stimulus packages of $2 trillion. Now we're talking about $500 billion, maybe $1 trillion. We hope to get through before the inauguration, but I think those hopes are fading, and you know, we have a situation where, you know, hopefully we get some sort of reset after the inauguration and we do get this fiscal situation through. But if the Senate goes the way of the Republicans with all these runoff elections and these sorts of things, then, you know, you could expect a little bit more of an adversarial situation in the US and not be able to get the fiscal stimulus package through that is needed. And when I say it's needed, it is needed in the near term, because a lot of people fall off the US's equivalent of the JobKeeper and they don't get that income support. And that is obviously something that will impact the US economy, which is so heavily reliant on retail and the consumer as we go into the new year.
Back to Australia, and RBA Governor Philip Lowe said unemployment would peak at 8% or 7%. And he said the recovery was very patchy and uneven. While some sectors were doing very well, others weren't doing that well. And I would say to get unemployment down to 5% would be a lot harder. While the latest job figures are very good, that came as a result of the economy opening up, and that was a low-hanging fruit. What would you say to that?
Yes, that's right. So, you know, we've done well on the labour market, surprisingly well. You know, it emboldens Phil Lowe and the board in their December press release to say, you know, the labour market has been, you know, stronger than expected. Probably a little bit too glass half full. For me, yes, like you say, low-hanging fruit. This is not jobs created like the government like to talk about. This is jobs returned to. These aren't new jobs. These are just jobs that were vacant, people had stepped away from because of the public health crisis. Now, I think the other thing that we need to be aware of is at some point the government will open up the borders and we will return to some measure of population growth. And this was really the challenge and the headwind before the coronavirus for the Reserve Bank to get the unemployment rate as low as they needed it to generate wages. It was this labour supply was more than adequate to meet labour demand. So we created lots of jobs. We just had lots of people wanting jobs. So we couldn't get the unemployment rate lower. What most central banks around the world have now acknowledged is moving from this NAIRU or a full measure of employment to, in the Fed's vernacular, maximum employment. Now, you know, I think it's very well acknowledged before the crisis that we needed the unemployment rate below 5% to generate any sustainable wage growth in Australia. I think we were moving to the point where we needed it at 4%. That's the sort of the ballpark that we need the unemployment rate at. Now, the problem with that is the Reserve Bank can't really do that by itself. We've seen that before the crisis, and we'll see it now. I don't really think, well, I'm less than convinced than perhaps the Reserve Bank is, that QE programs, very low bond yields, very low policy rates will actually generate enough jobs in the Australian context. And where I worry about it in 1 or 2 years' time is that we'll have this stubbornly high unemployment rate that's around about sort of 5.5%, 6%, because what the government has also said, and I hope that they revisit this, is that they will start more proactively removing fiscal support from the economy once the unemployment rate hits 6%. Now, I don't think that's low enough. If you look forward a couple of years to when the Reserve Bank and the government think this is going to happen, the unemployment rate hits 6%, the government starts removing fiscal policy support, monetary policy support can probably give no more. How do you get an unemployment rate down from that 6% to 4%? The economy will need to be flying for that to occur with just momentum, and you have contractionary fiscal policy working against that. So I don't believe that will be the case myself. So that's where I worry about. The economy will recover, but we're not moving to something better. I think the government will have to be far more proactive in getting the unemployment rate down to help the Reserve Bank, who are just going to have to keep their policy settings entrenched to get the unemployment rate down to where we want it to get the wages growth that we desire. And Phil Lowe has talked about a wages growth number, that 3.5% year on year, if they are to get inflation back at the bottom of the target band. Noting that the RBA has failed in this over the last 20 quarters to get trim mean inflation year on year at the bottom of their target band. They're failing at their mandate. So they need this wages growth to meet their mandate. And I just don't think that they can do that by themselves.
And so we're going to have more proactive government support to get unemployment down. That means keeping on supporting JobSeeker and JobKeeper and any other programs that they might.
I think it's really about job creation rather than labour market support. So, this is allowing businesses to invest and employ and have a certain outlook. The Reserve Bank certainly provided that, telling the market that it thinks interest rates are going to be low for an extended period of time, 3 years. So the government needs to sort of do these things as well. So I think it's less about labour market support and more about small business and business incentives to get people hiring again, get people a little bit more confident in the outlook. And this is sort of going to need reforms. And this is what we sort of want to see the government moving towards. We know that in the context of the broad sort of church of fiscal policies that can be enacted, the spending ones are quite easy. Tax cuts are quite easy. That's just spending. That's just, the government's got a free hit on what the deficit's going to be over the next couple of years. So they're quite easy. Where it becomes more difficult is enacting reforms. They're difficult to sell to the electorate. They're difficult to get through Parliament. So I think that's really the challenge for fiscal policy makers, who are, to my mind, not only taking over the mantle of fiscal management in the near term and through this crisis, but they'll be doing it for many, many years to come, because we know central banks around the world are sidelined, well, not sidelined in what they can do. They can certainly do more, but I'm not sure they can do more that's effective, and not sure that they can do more that's effective outside pushing up asset prices, which we see in the US with their equity market, and what we're going to see in Australia with the Australian housing market looking to gather some momentum, shall we say, in 2021.
Well, Alex, that's fascinating stuff, and certainly something we have to watch out for next year. And thank you very much for your time.
Anytime, Leon. My pleasure.
So what's happening in the news? Well, first, the good news. The Westpac Melbourne Institute of Consumer Sentiment lifted by 4.1% to 112 in December from 107.7 in November. The surge in the index continues. It is now 48% above the low in April and has reached its highest level since October 2010, marking a 10-year high. After only 8 months, the evidence seems clear that sentiment has fully recovered from the COVID recession. The behaviour of the index highlights a difference between this recession, the downturn during the global financial crisis, and the recession of the early 1990s. And businesses are the most confident they've been for more than 2 years, with corporate sentiment buoyed by growing evidence of a national COVID-19 economic comeback, tumbling into state borders and Victoria's much delayed reopening. NAB's Business Confidence Index lifted for the fourth consecutive month in November, climbing 9 points to 12 points, pushing above the long-term average and far higher than the neutral zero level, which represents a balance between optimists with pessimists. The index dropped to more than 60 points below zero at the height of the pandemic, but has since recovered at a rapid pace and now sits at its highest level since January 2018. And Victoria's reopening has sparked an acceleration in the job ads recovery through October and November, with ANZ job ads up 27% over the 2-month period. ANZ job ads are on track to match or even exceed pre-COVID levels by the year end. This suggests that the rebound in national employment could continue into early 2021 at least, although the lagged recovery in full-time employment remains a concern. And Victoria and New South Wales have lost their prized AAA credit ratings, with ratings agency S&P Global downgrading both states on Monday in moves that put a cloud over the federal government's own AAA rating. S&P Global cut its long-term rating on Victoria by 2 notches to AA stable from AAA watch negative, citing a weaker fiscal outlook. The prolonged lockdown in the state due to 2 coronavirus outbreaks this year has led to more significant effect on the state's economy than elsewhere in Australia, and the government's path to fiscal repair would be more challenging, the international ratings agency said. But in something of a surprise, New South Wales also lost its coveted AAA rating. The state's long-term issue credit rating fell 1 notch to AA plus stable from AAA negative, as the coronavirus pandemic slashed revenue projections and fueled public spending on New South Wales' large infrastructure program. The stable outlook reflects S&P's expectation that New South Wales' budgetary performance will improve during the next few years as the economy climbs out of a COVID-19-induced recession. But new borrowings will see New South Wales debt rise substantially to level consistent with AA plus rated peers. Meanwhile, S&P said Victoria's operating and after capital accounts deficits and debt burden had deteriorated sharply as a result of the coronavirus pandemic, mobility restrictions and a big spending budget. Victoria's debt is expected to reach about 200% of operating revenue in 2023, up from 70% in 2019. Victoria's after-capital account deficit was expected to remain large and debt levels were expected to be elevated for many years, S&P said. S&P also removed Victoria from Credit Watch Negative and said its outlook was now stable. Before this downgrade, Victoria was one of few state governments globally with a AAA rating. And the Morrison government has unveiled controversial legislation that will see casual workers able to apply for permanent roles after a year in the job, but remove the right of misclassified employees to claim billions in back pay. Employers will be required to offer part-time or full-time roles to people after 12 months if they've worked a regular pattern of hours for the previous 6 months and could continue without a significant adjustment to hours. Employers will retain a right to refuse if they have reasonable grounds to do so. Unions warn the bill will only entrench casual work. The bill will also seek to cover employers exposed to up to $39 billion in claims following a court ruling under appeal over misclassified casual workers. Part-time workers in the food, accommodation and retail sectors will have access to more hours, but will forego overtime payments under changes proposed by the Morrison government. The reforms planned for the 3 sectors hardest hit by COVID-19 are among measures announced under the Omnibus Bill. Under the proposal, part-time employees covered by 12 awards can agree to work additional hours on their usual rate of pay. Employers in 12 award areas hit hardest by the pandemic will be granted exemptions under the Fair Work Act for 2 years, enabling them to alter the terms of employment of their workers. As well, the Better Off Overall Test, or BOOT, the safety net that underpins the enterprise bargaining system, will not just be diluted to make its interpretation by the Fair Work Commission less rigid, but in some cases also will be able to be effectively bypassed for 2 years. And unions are opposing the Coalition's proposal for casual work, the creation of a new part-time flexi role and a high bar set for wage theft penalties. The Australian Council of Trade Unions' concerns include the proposed part-time flexi role, allowing part-time workers in accommodation, food and retail to take on up to 16 hours a week of extra shifts without being paid extra for overtime. ACTU Secretary Sally McManus said Labor and the crossbench should prevent the passage of the reform through the Senate unless changes were made, including granting the Industrial Tribunal powers to force businesses to make some casuals permanent. McManus said she welcomed any laws that would address wage theft, but that the bar the Morrison government proposed was too high. And construction, manufacturing and mining are set to cut the most jobs in both the short and long term, and COVID-19 restrictions will only further exacerbate the shrinkage, according to a new report from the National Skills Commission. The report shows that over the next 5 years, Australia's restrictions on population flows due to the pandemic will subtract 25,000 jobs from the construction industry, or 2.1% off the current workforce. In other words, more than 2 in every 100 existing workers will lose their job in the next 5 years. It's worse in manufacturing, where there'll be a 2.5% contraction in the number of workers. Mining and agriculture are expected to be hit hardest, as forecasts of lower exports and higher exchange rates and the speed of technological adoption carve off 27,000 or 11.2%, or 16,400 or 4.9% respectively from those industries. However, the NSC notes it has used export forecasts from the International Monetary Fund as the basis of its modelling, and these are likely to change. The winner from COVID-19 is the health sector, with healthcare and social assistance to see a 205,900 or 11.6% rise in job numbers. More jobs will also come for higher skilled workers in education and training, up 85,100 or 7.9%, and the professional, scientific and technical services, up 65,800 or 5.7% over the next 5 years. And Prime Minister Scott Morrison has new powers to veto or scrap agreements that state governments and universities reach with foreign powers under laws that could stymie China's Belt and Road Initiative in Australia and further inflame tensions between the trading partners. The laws passed by Parliament on Tuesday will give the Foreign Minister the ability to stop new and previously signed agreements between overseas governments and Australia's 8 states and territories, and with bodies such as local authorities and universities. Morrison's government will be able to block or curtail foreign involvement in a broad range of sectors, such as infrastructure, trade cooperation, tourism, cultural collaboration, science, health and education, including university research partnerships. An early target is likely to be an agreement the Victoria State Government signed in 2018 to join President Xi Jinping's signature infrastructure building BRI. The laws could further worsen ties between Australia and its largest trading partner, which have been in freefall since April, when the Prime Minister called for an independent probe into the origins of the coronavirus. Beijing has since inflicted a range of trade reprisals, including imposing crippling tariffs on Australian barley and wine, while blocking coal shipments. With the new law, the Morrison government will immediately examine whether to scrap Victoria's Belt and Road Infrastructure Agreement with China. The Foreign Relations Bill gives Victoria 3 months to explain to the federal government why the deal is in Australia's national interests. Independent Senator Rex Patrick failed to get enough support for the upper house to insist on an amendment, making the Foreign Minister's decision subject to judicial review. And Australia has issued a warning on trade, saying uncertainty from its souring ties with China and the lingering impact of an earlier drought will push down the value of its agricultural exports. The value of shipments is set to decline 7% in 2020-21 to the lowest level in 5 years, according to a report from the government forecaster, ABARES. While that's a slight improvement from its September estimate of a 10% slump, the downturn comes in a year of solid domestic production growth. Australia's agricultural industry has borne the brunt of escalating trade tensions between Beijing and Canberra that threaten serious disruption for an expanding number of exporters. The most recent hit came last month, when China slapped anti-dumping duties of up to 212% on Australian wine on top of trade measures that impact other commodities, including timber, barley and lobster. And thermal coal exports to China from Australia's busiest coal terminal have completely stopped amid escalated trade tensions and an unofficial Chinese ban on Australian coal. Newcastle is the largest coal port in the world, and trade with China made up 20% of its exports last year. No ships have left for China in December, and there are none listed in the schedule leading up to Christmas. Fourth quarter exports to China are down 82%. And the Transport Workers Union will test Qantas's decision to outsource thousands of ground handling staff in the federal court. The union will allege that Qantas breached the Fair Work Act by outsourcing 2,000 ground handling roles to third-party contractors like Swissport and Menzies Aviation at 10 airports around the nation. The outsourcing is part of a broader cost-cutting drive at Qantas, which seeks to save $1 billion a year by the 2023 financial year as it recovers from the COVID-19 pandemic. About 370 more ground handling jobs at budget subsidiaries Jetstar and 50 bus drivers based at Sydney Airport also face outsourcing, but the TWU court action only covers the ground handlers hit at the mainline brand. And the Council of Financial Regulators has demanded banks, insurers and super funds improve fortification of computer systems, issuing a detailed new framework to govern a series of simulated cyber attacks. Banks have been ordered to adopt a proactive rather than a reactive stance as cybersecurity, including hiring new independent teams of red hat hackers to secretly deploy the latest techniques against institutions to expose weaknesses. It comes ahead of industry-wide cyber resilience exercises to be overseen by the Council, comprising Treasury, the Reserve Bank, APRA and ASIC. Under the Cyber Operation Resilience Intelligence-led exercises framework, red teams, who will be shadowed by internal white teams, will use advanced adversary simulation capabilities, including seeking to hack bank staff to get access to internal networks, simulating a real-life adversary in a production environment. The techniques will use opportunistic malicious media drops and social engineering, and also malicious insiders to attempt to break defence policies. Once inside systems, adversaries will attempt to initiate payment instructions to steal money from banks. While banks, insurers and some super funds already use red hats to try to identify vulnerabilities and attempt to penetrate systems, under the new framework there will be fewer traditional testing restrictions, and attacks will take place over longer time periods, mimicking real-world threats. Under the simulation plans, attacks will go on for 12 to 14 weeks. The Council said the simulations would recreate tactics, techniques and procedures of real-life adversaries, creating and utilising tools, using techniques that may not have been anticipated and planned for. And Metcash said sales momentum has continued into the first 5 weeks of the second half, as a supermarket operator and hardware retailer unveiled a profit rebound and higher dividend in the first half. Group revenue increased 12.2% to $7.1 billion and 12.3% to $8.1 billion, including charge-through sales. Underlying profit after tax increased 43% to $129.6 million. Statutory profit after tax of $125.1 million compared to a loss of $151.6 million at the same time last year. And the corporate watchdog's case against mining giant Rio Tinto and its former executives Tom Albanese and Guy Elliott has been pushed back until 2022, so both men can be vaccinated for the coronavirus before travelling to Australia to testify. While the vaccine is expected to be rolled out within months, the federal court has taken an ultra-cautious approach and decided to vacate the trial originally scheduled for March 2021, given the high infection rate in the US. The Australian Securities and Investments Commission launched civil court action against Rio Tinto, former CEO Mr Albanese and CFO Mr Elliott, alleging they engaged in misleading and deceptive conduct over the valuation of the company's Mozambique assets. Rio Tinto, Mr Albanese and Mr Elliott are vigorously defending the Australian case. The case centres on Rio Tinto's 2011 acquisition of some coal assets in Mozambique for US $3.7 billion. Those assets were sold just 3 years later for only US $50 million. ASIC alleges Rio's 2011 annual report misrepresented the value of the reserve. ASIC is seeking fines and to have both men barred from being a director of an Australian company. The court had been mulling potentially holding the trial over video conference. However, New Jersey-based Mr Albanese and London-based Mr Elliott both successfully argued it would be fairer to them to be in Australia during the trial to instruct their solicitors. The court was also facing the mammoth task of managing the trial across 3 locations in separate time zones: Sydney, New Jersey, London. And the Arnott's Group, which owns some of the most well-known biscuit, cooking and soup brands in the supermarket aisle, will pour $8 million into expanding its Campbell's canned soup factory in Shepparton, Victoria, to transform it into a hub for an expected 4-fold lift in export volumes. The sizable investment is being driven by a growing taste for the soups in Asia, in contrast to flatlining and, in some categories, declining sales in Australia, with the Shepparton plant to manufacture an extra 16.5 million kilograms of Campbell's soups and stocks each year, reflecting a 30% lift in volumes. However, Arnott's is not overexposing itself to the prickly trade relationship between China and Australia that could endanger its Asian export strategy, as it has done to the nation's wine, coal, barley and beef industries, and is focusing markets on China's doorstep, such as Taiwan, Hong Kong and Thailand. And that's it for this week. And next week I'll be talking to Tammy Sherwood, CEO of Person-Centred Care Australia, with its app-based mobile care monitoring for the aged. And I'll be talking to AMP Capital Chief Economist Shane Oliver about the market and his predictions for next year. In the meantime, you can find me on Twitter talking BizBellZZ, on Facebook and on LinkedIn. And if you want, leave a comment. Wishing you all the